Over the past week or so, Q1 earnings reports have slowly started being released by publicly traded companies, and most investors have been waiting patiently to get their hands on these financial documents in order to see the scope of the financial damage. Well, the Q1 reports for most Canadian real estate investment trusts have now been released over the past week or so, and in today's video, we're going to be analyzing one of Canada's largest and most popular REITs. Hey, what's going on, savers and investors? I hope you're all having a great day as always. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be diving into a full analysis of the Q1 earnings report for RioCan REIT, which is one of Canada's largest real estate investment trusts and always gets requested on this channel when I speak about REITs. I've made a bunch of videos on the channel already speaking about various real estate investment trusts, and these tend to be pretty popular with the audience, most likely due to the fact that the Canadian real estate market is really hot and continues to boom over the past 5 years and has no end in sight, and also due to the fact that for portfolio investors, real estate investment trusts provide a really good dividend income. Let's first take a look at the current share price of RioCan. Now, I know by the time you see this, it will have changed most likely, but I'm filming this at around 6:30 p.m. on Wednesday. So currently the share price had closed at $14.76, which is down roughly 46.5% since the prices that were showcased in February. Since March, the share price has somewhat rebounded by roughly 18.5%, but regardless, considering the fact that it is currently still down about 46% from the prices in February, in this video we're going to look at whether or not this is justified and if getting in on RioCan at this price point is a good decision or not. Now, in my recent video going over a comparison of 6 different Canadian REITs operating in different facets of real estate, Morningstar's annual forecasted revenue growth was roughly negative 7.9% for RioCan, mostly attributed to the fact that this REIT operates in the retail sector, and most likely, depending on the severity of the medical issue and period of time that stores would be closed, tenant income may have been truncated. In addition to this, we determined that the funds from operations per share were roughly $1.87 per share, or roughly 0.46 cents per quarter, and at close of 2019, the company also had a decent balance sheet from a total asset versus liability standpoint at $15.18 billion in total assets and $6.88 billion in total liabilities, but the short-term balance sheet was somewhat of an issue at only $375 million in short-term assets and $1.29 billion in short-term liabilities, which could have potentially been an issue depending on the severity of truncated revenues in the short term that we weren't aware of at the time of that video. Now that we have Q1 earnings and balance sheet figures though, we can at least have a somewhat of a better idea of how the company is adjusting from a financial standpoint. In the case of RioCan, the Q1 financial statements and letter to shareholders was released a couple of days ago on May 5th, and I've had the chance to go through it and come up with some conclusions on where I think the REIT stands even during this very out of the ordinary market period. Obviously, this document is extremely long at 97 pages to be exact, but I had the time to read the entire thing, and I'm going to be boiling down the main elements for you so that you can get a good picture of what's going on with RioCan. We'll mainly be running through the revenues, the funds from operations, the net income, balance sheet strength, and forward-looking information, but before that, let's cover what the CEO and board of directors have spoken about to shareholders to get a sense of how the company has coped as of now in Q1 of 2020. In the letter from the CEO, Edward Sunshine, I think that's how you pronounce his name, starts off with somewhat of a bang, stating that RioCan's results for the first quarter were strong and that the reported funds from operation per unit were 46 cents per share, which is actually the same as in 2019, as we'll be looking at shortly. Now, the net operating income remained unchanged at 3% for the commercial portfolio and saw continued momentum in leasing activities and condo pre-sales for the residential portfolio. The rest of the letter pretty much goes on to speak about the current medical situation that the company is living through and that they're still planning on expanding the residential portfolio by roughly 40 million square feet, due primarily to the fact that provincial governments have deemed their construction projects as essential business, which is definitely a positive for the company company and has allowed them to stay on course with the majority of their development projects. Those are really the main highlights of the letter from the CEO, and if you want to read this in detail as well as the rest of this entire financial document, I'm going to be leaving a link down in the description where you can easily access this whole document. Now, another important factor to look at in order to pre-frame all the financial numbers that we're about to speak of, let's cover RioCan's real estate portfolio key facts, because this gives some tremendous insight into the reason why they have fared so well throughout Q1 and will most likely continue this trend in Q2. First of all, let's bring our attention to the total portfolio occupancy rate for the commercial properties only, but nonetheless, the total commercial occupancy rate is 96.8% throughout the 206 income producing property that this company currently has in operation. They have 16 properties under development, but of these 206, 96.8% of them are rented out. This figure is extremely high and positive for any real estate investment trust where the main revenue source is from rental income. The most important factor, however, is the fact that RioCan has a very diversified portfolio of tenants, with each one of them accounting for no more than 5% of their total revenues. So in a period where some retailers may be closed, this limits their revenue exposure to each individual company, which is positive. For example, these are their largest revenue sources by tenant, and as we can see, a lot of them are deemed as essential businesses. Canadian Tire representing 4.9% of their annualized rental revenue. In some provinces, Canadian Tire is back up and running. Now, Loblaw is coming in second place, as well as Shoppers Drug Mart. These are essential businesses that have never closed their doors even during this whole medical situation. Looking at this top 10, most of them are all still open: Metro and Jean Coutu, Walmart, Harvey's, Montana's, Swiss Chalet, as well as Bank of Montreal and Sobeys. So in this regard, I do have to admit that RioCan's portfolio is somewhat attractive from a tenant perspective in that it is very resilient to market cycles, with most of their tenants being essential businesses that will continue serving customers and be able to pay rent. In fact, 75% of the trust's total annualized rental revenues as of March 31st, 2020 were derived from necessity-based and service-oriented tenants, which is 50 basis points above the 2019 year end. In addition to this, regarding RioCan's residential units, none of them are currently rent controlled under current legislation, meaning that they can continue rental increases in the near future. In fact, the net operating income of the trust's residential rentals was $1.9 million in the first quarter of 2020, which is an increase of $2.4 million from Q1 of 2019, where the trust had reported a net operating income loss. If you aren't sure what the net operating income, or NOI for short, is, this is a calculation used for rental properties to analyze their income generating potential without taking into consideration debt financing such as mortgages. So it takes the revenues and deducts all other expenses such as taxes, maintenance, staffing, and etc. As we can see though, at only a couple million in revenues and net operating income from residential properties, RioCan's main business is from retail and office spaces, but I still thought it would be important to highlight the fact that residential rents were really not all that affected, with 97% of their total rents from retail, residential, and office spaces being collected in Q1 of 2020, which I don't think anyone was really expecting. With that said, let's keep in mind that RioCan has stated that as of April 30th, 2020, which does fall in the Q2 period, they've approved approximately $15 million of April rent for deferral based on requests from their tenants. This represents approximately 17% of its total April gross rent on proportionate share basis, and that for these approved rent deferrals, they are payable either within the 12 months subsequent to the 60-day deferral period or over a shorter time frame in certain cases for small national tenants. Basically what this means is that these rent deferrals are going to be reflected in Q2 and Q3 earnings reports. In fact, they even state quite boldly that the current medical situation has had little to no impact on the trust's rent collection or financial performance for the first quarter of 2020, but we will be looking at that for ourselves when going through all the numbers in the income statement, cash flow statement, and balance sheet. It's It's actually sort of interesting that even when stating that the medical situation has had no impact on their financial operations, they are still deferring municipal taxes and reducing energy consumption, limiting staffing measures, and reducing revenue-enhancing capital expenditures. So I guess this is a good thing that even though the revenues and financing operations are somewhat untouched, they're still taking the proper measures to reduce operating expenses, which is always a good thing for income-generating real estate. Moving on to the selected financial and operational information. At first glance, when looking at this sheet for Q1 of 2020 versus Q1 of 2019, the revenue figure can be quite striking, with revenues seemingly having a difference of about $36.8 million because all these figures are in thousands. The same assumption would also be true for the net income, seemingly dropping by $92 million. However, with a REIT, keep in mind that the sale of a property, creating a capital gain for that quarter or year, is added to the revenue and in turn to the net income as well, which skews the relative amount of income that is derived from quality rental income paid by tenants, which is the lifeblood of a REIT ultimately. RioCan has offloaded some properties in Q1 of 2019 for a total of $88.3 million, so that's why this figure is much higher than Q1 of 2020. In fact, when taking these factors into consideration, there was actually even an increase in net income by $3.6 million between these two Q1 periods. However, what's much more important for a REIT is you want to see an increasing funds from operation, or FFO for short, because this is a true sign of the financial health or stability of a REIT, as it takes into account revenues, depreciation, and amortization, and then subtracts any gains from sale of property, which is a much more indicative of the cash flow for a REIT. In the case of RioCan, we can see that the funds from operation has actually increased by roughly $2 million, and considering the fact that the trust has distributed an extra 12 million shares out to the public, the fact that the FFO per share has stayed basically the same, this is good news. In the case of RioCan, we can see that the funds from operation has actually increased by roughly $2 million, and considering the fact that the trust has distributed an extra 12 million shares out to the public, which dilutes the share value per share, the fact that the FFO per share has stayed basically the same, this is relatively good news, meaning that the FFO is going up. In terms of the overall net operating income of the fund for properties that they already owned and managed, RioCan has done a great job at increasing this amount, being able to grow the NOI of same properties by 3% in Q1 of 2020, which doubles the comparative growth of only 1.4% in Q1 of 2019. This is primarily due to the fact that their net operating income from the residential properties went from negative $521,000 to $1.83 million in 2020, and that they dramatically increased their net operating income from properties they had acquired, which includes properties acquired or disposed of during the periods being compared, so Q1 of 2019 and 2020. I would like to bring your attention to the residential inventory section, where as of 2020, RioCan has not actually disposed of any income generating properties, so this is the reason why there is practically nothing in sales and cost of sales section in relation to 2019 figures where they had disposed of several properties. However, even though the trust hasn't offloaded any properties in Q1 of 2020, they have been in the process of acquiring 6 investment properties for an aggregated purchase price of $98 million for their stake in those real estate investments. It also expanded its development pipeline by 12.9 million square feet, which, as we spoke about at the beginning, has expanded their total development projects now to over 40 million square feet. So the company, from an expansion and acquisition standpoint, really is showing no signs of slowing down even during this market climate. So with all of this information considered, in reality, what was stated above about their operations being basically untouched, they were right in saying so from an income and funds from operation perspective. Another small detail that I want to mention here is the fact that the FFO payout ratio, which is the trust dividend payout ratio, related to the funds from operations rather than net income, because remember, FFO is much more relevant for a REIT, it actually decreased by 0.5%, staying under the fund's target of 80%, so this is great from a dividend perspective. With all that covered, let's now quickly dive into the balance sheet of RioCan and see if there are any surprises. Now taking a look at RioCan's balance sheet and the highlights for the first quarter of 2020, the trust has actually been able to increase its total assets by about $200 million since the end of 2019, and the company was also able to increase its cash position by roughly $35 million since 2019's same period. Now honestly, nothing else really jumps out to me for the assets category. The current cash and cash equivalents has changed, however, due to the financing activities that we're going to cover shortly in the debentures payable section of the liabilities. Quickly though, I do want to mention one thing that could be confusing. It states here that as of March 31st, 2020, RioCan had $1 billion in liquidity available to them through cash and cash equivalents, as well as undrawn lines of credit, which we can see right here. Now this does not mean that the company has $1 billion of cash just sitting around. As we just saw, they have $85 million of cash and cash equivalents. The other $915 million is in the form of credit lines that they have available to them, meaning that if they were in a tough situation where cash positions were low, income was not coming in, and they needed to access some capital or just to use as financing for construction costs, this money is available to them in the likes of around $1 billion. The trust is even taking it upon them to refinance a fair amount of their debt into lower interest rates. For example, the trust has reduced its floating interest rate debt exposure down to 3.5% from 6.4% on December of 2019, and it's lowered its weighted effective interest rates to 3.35% down from 3.44%, which may not seem like all that much, but it does make a difference when we're speaking about millions of dollars worth of debt. Speaking of debt, obviously with the nature of a real estate investment trust, these types of companies typically carry higher levels of acceptable debt than a typical company in the form of mortgages, because this is a staple financing activity for real estate activities. As of Q1 2020, the debt to total assets ratio for RioCan is only 43%, which may sound quite high, but is actually relatively low compared to most other REITs in Canada. In addition to this, the trust had $400 million in current payable debentures due in August of 2020, which they practically covered in its entirety by issuing new green bond debentures in the amount of $350 million at an annual coupon rate of only 2.361%, maturing in 2020, which is an extremely low interest rate. If you think of it, honestly, this was a great move. So even though the trust has $400 million in payable debentures in the short term, it managed to raise $350 million in new low coupon debentures, which is visible in the company's cash flow statement. And finally, let's quickly speak about RioCan's dividend, because currently a lot of people are wondering whether or not these real estate investment trusts are going to be able to maintain their high dividend yields. In the case of RioCan, the dividend yield is currently at around 9.7%, I think, if I'm correct, and that is translated for Q1 of 2020 into $114 million worth of distributions paid to shareholders, which we can see on this line right here. So in this entire financial statement and document related to the financials for Q1 of 2020, I didn't see anything related to a cutting of dividend payments. So in my opinion, currently, due to the fact that their revenues are not being truncated and business is basically as usual, I pretty much have no worries that dividend distributions will continue being paid out to unit holders. And so for this reason, if you were to get in right now, a current dividend yield would be just under 10%, which is crazy for any stock, but a real estate investment trust is typically going to pay out a higher dividend yield. So this is essentially nice for a dividend investor. I really hope that this walkthrough of RioCan's Q1 earnings report, as well as balance sheet and letter to shareholders, was beneficial to you. And if you want to see more content like this, make sure to smash the like button on this video and leave a comment down below letting me know that this type of content is of value to you. Now that we have a better idea of RioCan's income statement, balance sheet, and operations during Q1 of 2020, what are my final thoughts on the company, and is it a buy? For starters, RioCan's revenues honestly stayed quite a bit higher than what I was personally anticipating for this Q1 period, considering the fact that most of their tenants are retail oriented, and I thought that there might be some truncated revenue. However, if you think about it, most of their tenants are essential businesses, meaning that they're allowed to stay open during this whole medical situation. In addition to this, they have a wide variety of tenants with no more than 5% of their income coming from each tenant, so this honestly gives me confidence as a potential investor. The second factor factor is related to RioCan's dividend income, which has managed to stay afloat and untouched during the first quarter of the year and currently translates into a nice dividend yield of 9.72%, which, even though this is relatively high based on the company's financials, I don't see the trust cutting or stagnating this dividend payment in the near future unless something relatively dramatic happens in the near future. Considering the current price point per share, I honestly think that RioCan is a good potential buy based on everything that we just covered in today's video, and I even think that it's somewhat undervalued compared to other real estate investment trusts in the Canadian REIT landscape. If we quickly calculate a projected price to FFO for 2020, which is basically the same thing as a price to earnings ratio but is more specific to a real estate investment trust, we take the current price of around $14.75 per share and then divide that by the current funds from operation per share, which is currently 46 cents, and multiply that by the 4 quarters in 2020, we get a price to FFO of around 8, which is under the Canadian REIT industry average price to FFO of around 12 to 13x. Now, obviously, if there would be any major tenancy and revenue issues, they would surface in Q2 and Q3 of 2020. However, due to the fact also that provincial governments are speaking about reopening most businesses back up within a month or so, I don't think that RioCan is going to be in a position where they're having truncated revenues for a long period of time, and ultimately at this point I think the REIT's going to be completely fine. With that said, I might make a quick update once Q2 earnings are released in a couple months. So with all that said, at the current price point per share, which is down roughly 45% since February, I think RioCan REIT could honestly be a great option for a long-term buy and hold real estate investment trust position for both some steady dividend income as well as capital gains over the coming years. So I really hope you enjoyed the quality of this analysis of RioCan REIT. If you did, please make sure to smash the like button. It really helps my channel grow and tells me that you enjoyed this type of content. And I've also been thinking of releasing a couple more videos of specific company analyses such as this one. Some viewers have already requested Air Canada, Algonquin Power, and a couple others, but let me know down in the comments which companies you would like me to analyze. So on that note, if you want to learn more about stock market investing, make sure to check out one of the 2 videos right here, and I'll see you in the next video.